with the S&P 500 being up 21% year to date, I'm gonna say it for the first time in a long time, I can't find value in the stock market. And I'm not just a growth investor or just a value investor or just a quality investor. I do a little bit of everything. I go between different sectors. This is, I would call it the everything rally, because everything has been rallying together and people don't really know what it means. And I'm not seeing a lot of people talk about it because it happened many times before, a lot of major pullbacks before 2018, before 2020, before 2022. And I've been finding some of opportunities. Like I talked about the energy stocks, but even the energy stocks are starting to move with the growth stocks, with the tech stock, even with dividend stocks and utility stocks and Verizon. Everything has been rising together. Most sectors, most stocks are pretty much green on the year. And as I said, this is extremely rare. It happened before a lot of the major crashes. And this is really not normal, because whenever you have rallies in the market, not all stocks go up together. You have risk on rallies and risk off rallies. And risk on rallies, you have a lot of the tech stocks, sometimes they go up, the Cassie Wood ARK ETFs, a lot of that stuff that goes up. But then you have the defensive stocks like defense stocks, some of the safety stocks, dividend stocks, they be pulling back. But now everything is pretty much rallying together. And I think it means something. And I'm going to tell you what it means in the video. I'm going to tell you why I believe the stock market is getting into overvalued territories and what I believe and what I think about it. And I'm also going to tell you where I'm actually finding opportunities in the stock market. And it's not in the United States, it's somewhere else. I'm going to reveal it at the end of the video. And I hope you watch the entire one. I hope you pay attention, because I think there's a margin for massive opportunity that I'm going to reveal very, very soon. And I really hope you enjoy it. If you do, press the like button and let me know what you think in the comments. Now, if you look at the sentiment indicator, which is the fear and greed index, we're nearing extreme greed territory. And you could also see it on this chart. We're nearing extreme greed. And I can see it because I'm not seeing as many bearish posts on Twitter as I used to see before. I'm not seeing the bearish videos of the next 2008 because the Fed is cutting rates or because the yield curve turned positive. I'm not seeing that stuff anymore. And I was against it and I was very bullish over the last few months. A lot of you guys know that stuff. But I think we're entering a phase where we should be a little bit more cautious, not just sell out of big cash 100%. But as Howard Marks says, you could adjust to the matter of risk. So be a little bit more cautious, a little bit more fearful. I think this is the time to be a little bit more cautious than people were a few months ago, as we're nearing extreme greed territory. This is another good indicator. It's the percentage of S&P 500 members outperforming the S&P 500 index. It's nearing around 70%. This is like history. And it happened before, 2099. It happened before pretty much 2020, a little bit before 2020. It happened in 2022, in 2021 mainly. And this is very, very interesting. And it's something to pay attention to. Now, if we look at some valuations, we look at a basic forward PE ratio for the S&P 500, it's around 21.4. And 21.4 is on the higher end. It's nearing the 2021 high, which I believe was around 22 to 23 times. Now we're at 21.4. And, we're nearing very high in terms of a historical basis. And if you compare it to the S&P 500 with the Magnificent Seven, this is an amazing comparison. So you look at the S&P 500's Magnificent Seven forward PE, which is in the red, it's sitting at 29 times forward earnings. But then you look at the green chart, which is the S&P 500 X the Magnificent Seven, you would believe that it should be cheap because the Magnificent Sevens are leading the rally. But this is not the case. And everything has been rallying together. And even the green line, if you see it, is trading around 19.2 times earnings, excluding the Magnificent Seven, which really had the most growth in terms of earnings in the stock market. And it's also nearing the highs of previous peaks in early 2018, late 2021. And it's getting very interesting. And that's what I'm saying, that it's not just the Magnificent Sevens going up and they're carrying everything else. It's mainly everything else now that's starting to catch up, even though you have NVIDIA up 152% and Meta, and a lot of them have been doing well. You have other stocks that have been going up together that, in my opinion, they shouldn't be going up as much as the Big Seven, because the Big Seven have really contributed most of the earning growth. Now, in terms of the recession, I don't say, guys, it's going to happen this year. And I've been talking about it. And even companies themselves, only 28 companies out of 500 companies in the S&P 500 cited recession concerns, or the word recession in general. Only 28. And people were talking about the yield curve. So whenever the yield curve turns positive, we're going to have a stock market crash. And it hasn't happened yet. And I've been critical of the yield curve, which is a 10-year minus the 2-year. I've been mainly paying attention to the 10-year minus 3 months, which I did say many times, it's nowhere close to turning positive. So we could always go higher before we go lower. And this is what's been playing out. But in my opinion, the main indicator and the main thing that's going to tell us if those multiples are sustainable. And in my opinion, those multiples are not sustainable. 19 times for the S&P 500, excluding the big 7, which contributed most of the earnings growth, is extremely overvalued. But even the S&P itself at 21.6 times is nowhere close to being undervalued or nowhere close to being fairly valued. I think it's mainly on the overvalued side, and it's pricing in a lot of earnings growth. And what's going to determine those earnings growth, in my opinion, is really who becomes president, because you have a massive difference in policies in terms of tax rate cuts or tax rate increases. And this is what happened after Trump implemented the tax cuts or rate cuts in 2018, late 2017. The S&P rallied 35%. And this is a big deal, guys. And that's another chart that would show you the earnings boost that a lot of companies got from a lower tax rate. And Apple, for example, back then, it got a 10% earnings boost. This is a huge deal. Google got a 5%. Berkshire got an 11%. UNH got a 16% earnings boost from the tax rate cuts. MA, MasterCard got an 11% boost. Home Depot, 12%. Costco, a 9% earnings boost. This is a big deal. This is a make it or break it, guys. In terms of the multiples that we're trading at, it's really going to depend on the kind of tax policies that we could potentially have. I think the Democrats want it at, 28%. Which they expire next year, and Trump wants them ideally, I believe, around 15%. I'm not sure if this is sustainable, but that's gonna, in my opinion, decide where the market goes from here. But if we do have more rate cuts, this rally could be sustainable. But for me, the way I look at it, the way I'm looking at everything, I'm looking at this multiple. Even though we could have a change in presidency, I think there's more downside than upside for most stocks at this price, especially for the S&P 500 index. I don't think it's the best bargain ever, and I would not be extremely greedy at those prices. I would be extremely fearful, and I am. I'm not extremely fearful, but I'm somewhat, fearful, you could say. And I'm keeping some cash on the side in case we have some kind of a pullback, which I believe will likely happen very soon. And I could take advantage of that stuff. Whenever everyone was greedy, I would have been a little bit more conservative. And that's what I try to do in the market. Now, by no means I'm telling you to go and sell all your stocks, because this is an amazing chart that would show you the difference between bull markets and bear markets. That, bull markets, they happen most of the time, and they tend to be long, 12 years, 11 years, 7 years. But then bear markets are like 1 to 2 years, and they're extremely short, and they don't happen as often. So I'm not saying that we're going to have the bear market of a lifetime or the crash of a lifetime, but I could easily see a 5 to 10% pullback. Yeah, I wouldn't be shocked at all. I wouldn't be shocked at all, especially if we have a different tax policy and those earnings boost, they go negative 15, 20% on earnings, and you have the S&P 500, trading at a perfect multiple, like nothing ever is going to happen. It's very interesting, and it's not the best setup to be extremely greedy and in my opinion, be 100% invested in buying everything we can. I don't think this is the time to be doing that. Now, having said that, I'm personally finding value. And it's not in the United States. I'm going to give you a quick tip. You could look into it and you could Google some stocks yourself. And it's not in the United States. But if you look at a neighboring country called Mexico, very interesting country. A lot of foreign investment is going there because we're moving out of China, from importing from China. And now Mexico is the largest trading partner of the United States. Yet this country is trading at 11 times earnings. It's the lowest multiple ever. And its currency was doing well, and the stocks were doing amazingly well. But you recently had a change in presidents. You have a new president, which the market doesn't like. And I believe there was a massive overreaction to the downside in a currency, in the economy, and even in the stocks itself, trading at 11 times earnings. You can go on Google, you could find out about all that stuff. And even though you might have some changes in policy, I don't think it's gonna be so major that it actually warrants such a massive decline. And I think there's a massive overreaction over there, and you have a lot of quality stocks trading at extremely undervalued multiples for a country that has good demographics, good economic growth, and lower inflation in the future. It's pretty amazing. And I'm finding a lot of opportunities. I'm sure you could find them on Google. You could research Mexican stocks and do analysis on them. But if you find out what I'm buying, you could join my group if you want. This is the link. But that's all I had to say for this video. I'm not saying we're gonna have a crash, but I think the market is extremely overvalued. And I wouldn't be surprised if we have a pullback sometime soon. And I don't believe this is the time to be extremely greedy, all in stocks, margin. I think this is the time to be a little bit more conservative and have some cash on the side and see what happens. And that's what I think about the S&P and stock market in general. Not financial advice. I hope you enjoyed it. If you did, please press the like button and maybe consider subscribing. So I'll talk to you in another video.